Hey guys, welcome to Benzinga Crypto. My name's John, and today Logan's going to walk us through the latest on Uniswap. Logan, take it away.
Okay, so Uniswap V1 was launched in November 2018 as a proof of concept for automated market makers, a type of exchange where anyone can pool assets into shared market making strategies. In May 2020, Uniswap V2 introduced new features and optimizations, setting the stage for exponential growth in automated market making adoption. Less than 1 year since its launch, V2 has facilitated over $135 billion in trading volume, ranking as one of the largest cryptocurrency spot exchanges in the world. Uniswap now serves as critical infrastructure for decentralized finance, empowering developers, traders, and liquidity providers to participate in a secure and robust financial marketplace. Today, we're excited to present an overview of Uniswap V3, and we're targeting a Layer 1 Ethereum mainnet launch on May 5th, with a Layer 2 deployment on Optimism set to follow shortly after. So John, are you familiar with the concept of automated market making and the general premise of what Uniswap does?
I'm definitely familiar with the general premises. I'm familiar with vaguely familiar with the concepts of like the automated market making and they building in like liquidity into the way that they run these smart contracts. I'm not like too versed with like the details of how that works. And I'd be very interested to understand it a little bit more of the technicals.
Sure. So Uniswap makes markets by creating pools that represent token pairs. So I'm trying to find where they are now, token lists.
Yeah, I remember, are they like the beginning and they launched this, like everyone got like a bunch of uni for free by being like one of the first members and everyone just got like $2,000. It's like, what?
Yeah, if you used it before the airdrop, they gave everyone 400 uni tokens, which is worth I think $10,000 right now. It's pretty crazy. So the user end product that Uniswap creates is an exchange for ERC20 tokens or any Ethereum-based tokens. So you can, for example, switch ETH to BAT, and a simple smart contract transaction executed on Ethereum blockchain can do this for you. And so it does this by tapping into these liquidity pools that are created by this automated market making concept. So smart contracts make the market, and liquidity providers, which Uniswap calls LPs, are the ones who fill them. So
what are they basically doing is like somebody puts up, this is how I understand it. So somebody puts up a smart contract saying that they have this amount of a token and this is what they want for it. And then Uniswap and these other similar tools basically just match you to those contracts and then executes them. And then if you have multiple, like, because you're requesting a certain thing, so they'll match. You won't necessarily get exactly what you want. If you want like a random number, if you want 10,017 like of a token, like it might not be able to make that happen, but it might be able to make you get very close to that. And so it just completes the different contracts to give you the tokens based on the smart contracts of what people posted up as what they want for their token. Is that accurate?
Yeah, that's pretty much the general idea of it. So the liquidity providers are the ones who stake funds into the pools, and the pools auto balance to keep a 50-50 split between the two tokens that they represent. And so depending on the amount of liquidity provided, is how much you'd be able to exchange at any given price point. So what Uniswap V3 introduces and what makes it different from V2 is concentrated liquidity. So this is the general idea, or this is like the big overarching concept that is really important to understand when it comes to Uniswap V3. So what this does is it allows liquidity providers to provide liquidity only at a certain range along the price curve. So I'm going to head down to this example that they have built into their website here. So typically in Uniswap V2, you would provide liquidity for the entire price curve, even going out to infinity. Like that's how all liquidity providers have worked before, even before blockchain, even before DeFi. Like all market makers would provide liquidity to the entire price range. What is novel about Uniswap V3 is that Hayden Adams, the creator, figured out how to target certain price ranges and concentrate the liquidity you provide along the price curve. So by say you want to provide $1,000 of liquidity to a pair, and it's an ETH pair to something. So you're going to provide it in the ETH price range of say like 1450 to 2,500.
Mm-hmm.
In V2, you would need $7,000 of capital to make the same returns covering the entire price curve. But because you can concentrate it, with this $1,000, you can get 7 times the amount of fees that you would if you were forced to cover the whole price curve. So what happens if the price goes below or above the limits that you set? That's what exposes you to extra risk and what allows you to make these extra gains. So there are limit orders placed at either end, and by having these limit orders in existence, you're exposing yourself to risk. And the way that Uniswap explains them is a fee earning limit order. I think this is what made it really click for me. Liquidity providers can sell one asset for another by adding liquidity to a price range entirely above or below the market price, approximating a fee earning limit order that executes along a smooth curve. So I'm just going to hop over to this Twitter thread that Hayden Adams, the creator of Uniswap, made. And I think that this does a good job kind of getting into the technical details. Okay, so Uniswap v3 provides the only possible solution to impermanent loss and price impact. It also lets you reduce your total price risk while increasing your impermanent loss relative to V2 with concentrated liquidity. Impermanent loss refers to the fact if you sell a token before it rises in value, you would have been better off to hold it and sell it at a higher price. Or if you buy it and it falls, then you would have been better off just to not buy it. Price impact refers to how much a trade moves the market price. So based on how many orders are placed at any given value, your one order may or may not have an effect depending on its size, and that's what price impact is. So price impact and impermanent loss exist in direct opposition to each other, which doesn't really seem intuitive at first. But the more a liquidity provider is willing to sell close to the market price, the more impermanent loss they experience. So say you're only willing to provide liquidity at $100 over like the current price. Say ETH jumps up to here, you're going to miss out on all gains. So that's the impermanent loss. That's why that's what you're exposing yourself to, and that's why you're able to earn these higher fees.
And so these are fees, so the fees are
fees are so when you want to use the Uniswap platform, you have to pay a fee in Uniswap's governance token Uni right here.
Right. Okay. So so that's percent of the fees that they get, because it's a decentralized thing, right? So you should be able to.
It's decentralized, yeah.
So you're collecting
exactly. You collect all the fees that for all the liquidity, market making, swaps that you provide, the transactions you provide.
I think I'm starting to, and this because you're provide. Okay, so I see. I think this makes a lot of sense. So it's if does it work? It probably doesn't work if it's a very illiquid market, or I guess I wonder, like, when does this not work? Or is it like, is this for like very low liquid assets? Does it work? Or does it just like help provide better liquidity for assets that already have a decent amount of trading volume? Is there anything on that?
So as you can imagine, the majority of orders and swaps are requested around the current strike price, right? And as you go farther out on the strike price curve, the less liquidity and the less demand there is for swaps. So by cutting off that huge tail end, you're really not cutting off that many transactions and that many fees, because the majority of them exist in kind of a bell curve around the current price. So it's up to your risk tolerance at the end of the day where you want to place these buffers. But when you do set your price range for your concentrated liquidity, what I think is really cool is how Uniswap represents that is with an NFT. And this is, I think, really crazy for the future of NFTs and of finance in general. So as a byproduct of per liquidity provider custom price curves, liquidity positions are no longer fungible and are not represented as ERC20 tokens in the core protocol. Instead, they have to be represented by non-fungible tokens, NFTs. Common shared positions can be made fungible via peripheral contracts or through other partner protocols, and trading fees are no longer automatic. automatically reinvested. That's not exactly relevant to what we're talking about now. But the biggest thing about all of this for me is this part right here. Over time, we expect increasingly sophisticated strategies to be tokenized, making it possible for liquidity providers to participate while maintaining a passive user experience. This can include multi-positions, auto rebalancing to concentrate around market price, fee reinvestment, lending, and more. So tokenizing trading strategies, tokenizing liquidity providing strategies is like taking off right here, right now. It's blowing my mind.
Yeah, this is actually really fucking cool. So, because I realized, I mean, I have to watch the video that you did at the University of Michigan Blockchain Club. I created a video yesterday that we're gonna launch here soon, but I realized, like, this is literally just data, right? It's literally just data on the blockchain. So you could put up anything you want. So you can put all the parameters you want, and that makes total sense why they would make this a non-fungible token to like just say what your trading strategy is.
Yep.
And then executes that trading strategy in a decentralized way in Uniswap.
Yep.
It makes so much sense. It's crazy.
Right?
All right. Wow.
Once it clicks, it's pretty wild.
Yeah, this is going to be really interesting. I'd be very curious where this takes the market. I mean, I guess the big thing is like it's scaling, right? We got to scale. We got to have Ethereum, and well, they said layer 2 technologies. Actually, that's the other thing. So what are they doing for technologies?
So they're planning to launch on mainnet pretty quickly, and then they're also planning to launch on Optimism. Layer 2 deployment on Optimism set to follow shortly after. So what layer 2 and Optimism is, so layer 2 is like a theoretical level above the blockchain that can be accessed via smart contracts. So they can make smart contracts on the mainnet so that you have the security of the mainnet. But these smart contracts are capable of offloading tons of work, tons of transaction volume, tons of like computing power to a completely different application. And Optimism is Andreessen Horowitz backed, and it's the most successful layer 2 application that is in existence right now. It's supposed to deploy in May 2021. So they actually already have started deployment, and they're working with Synthetics, I believe, is the token that they're working with already. Yeah, but obviously their Uniswap partnership is coming pretty soon as well. So Optimism should be able to process around 2,000 to 3,000 transactions per second, when the mainnet Ethereum can only process 15 per second. So this means that fees for Uniswap are going to drop drastically, and swaps are going to become way more practical. There's going to be way more liquidity providers coming in that are no longer priced out by the huge gas fees.
That's really cool. So for this layer 2, so layer 2 with Optimism. So it's not even launched yet.
What's not launched yet?
You said it's coming in May. The layer 2 for Optimism.
Yeah, so layer 2 is not like unique to Ethereum. Other blockchains have done like layers before, but ETH needs a second layer to scale in time for the DeFi boom that's going on right now before they finish their 2.0 upgrade.
Yeah, don't forget about the NFTs, dude. Got some digital art moving.
Exactly. Yeah, that too. I mean, all of it is just clogging up the network right now.
Yeah, I think it'll be very interesting because, like again, this is just like these NFTs are just data. So it's like it's like you can represent a $69 million digital artwork, or you can provide rules on how you're trading on a decentralized exchange with an NFT. So it's like, that's the range of that hopefully helps click like who knows where this could go. I mean, I think tickets make a lot of sense.
And trading strategies too.
The interesting thing too that we'll have to cover is trading strategies. The interesting thing too that we'll have to cover is maybe click when you had on Rarible, like there's like a private file that you can access and hide. Like there's ways that you can definitely make some interesting applications by having that file behind something that you have to own. So I'd be curious. I'd have ideas of where that could go, but it would be interesting. We'll have to explore those ideas and see if there's anything out there that people are already doing with that and how they're using it. Games though, there's going to be a lot of games that should just be used from this.
Most definitely. It makes perfect sense.
Yeah, cool. Yeah, we have a lot more to look into. I'm really excited to see, hopefully May 5th. It's coming up. Oh, we got April.
Yep, right around the corner.
Still pretty close. It'll be exciting. All right. Thanks, Logan. You have anything else
John.
on V3?
Nope, that's all from me.
Very cool.
To the moon.
Yeah, to the moon. Keep it decentralized, guys.